In any economy, a business faces a strict mathematical choice: react to the market or dictate its terms. A pure monopoly sits at the furthest extreme from perfect competition. Under perfect competition, thousands of firms fight for fractions of a percent of total output. Here, the boundary between the company and the market vanishes. The firm is the industry. This structural isolation is maintained by imposing severe barriers to entry. A firm might hoard exclusive access to a localized resource or capture a highly specialized labor force. Governments frequently build these walls themselves, granting exclusive production rights through patents, copyrights, and operating licenses. Other barriers are purely mathematical. In a natural monopoly, the massive scale required to build infrastructure like a power plant results in declining long-run average costs. Smaller competitors simply cannot survive the math. Because they are the sole supplier, the monopolist faces the entire downward-sloping demand curve of the consumer base. This isolation changes the firm's geometry entirely. They no longer take the price given to them, they make it. This graph charts that power. This downward-sloping demand curve represents the exact maximum price consumers are willing to pay for every additional unit of output. To sell a higher volume, the firm faces a strict constraint. They cannot easily charge different prices to different buyers. To convince one more person to buy, they must lower the price for everyone. By discounting all preceding units, the actual revenue gained from the final sale drops below the sticker price. This creates a separate geometric entity, the marginal revenue curve. It originates at the exact same price point, but falls twice as fast as demand. In a perfectly competitive market, a firm sells all it wants at a flat market rate. Its price and marginal revenue are identical. A monopoly operates under different laws of physics. Because they control the total supply, continually dropping the price eventually pushes them into the inelastic region of the demand curve. They lose more revenue on the discount than they make on the volume. This mathematical gap, where marginal revenue is persistently lower than price, is the exact footprint of market power. With revenue curves locked, we map the costs. We introduce the marginal cost curve, a checkmark representing the cost of each additional unit. Next, we layer the U-shaped average total cost curve, hitting its minimum exactly where marginal cost crosses. Every rational firm follows a singular directive. Profit is maximized exactly at the point where marginal revenue equals marginal cost. Producing even one unit past this intersection guarantees that the cost of making the product exceeds the revenue it generates. Whether a firm is one of a million competitors or a lone titan, this intersection remains the unbreakable equilibrium. Marking the MR and MC intersection locks in the profit-maximizing quantity, Qmax. Follow that quantity up to the demand curve to set the price, revealing the maximum consumers will pay. Finally, pinpoint where that line crosses the average total cost curve to evaluate cost. The difference between that price ceiling and the cost floor, multiplied by the total quantity sold, generates a rectangle of pure economic profit. In a competitive market, these margins attract new entrants, eventually driving prices down. Protected by structural barriers, the monopolist's profit persists indefinitely. The firm leverages the consumer's own demand against them, purposefully restricting supply to extract the maximum possible economic rent. A perfectly competitive market continues producing right up to the point where price equals marginal cost. That is the socially optimal output. The monopolist stops early. This leaves a gap where consumers are still willing to pay a price higher than the cost of production, yet those units are never made. This artificial restriction creates a geometry of failure, a red triangle bounded by demand, marginal cost, and our capped quantity. This is deadweight loss. It represents value that should have existed, and trades that would have benefited both parties entirely erased. It is a permanent reduction in societal well-being. Even in monopolistic competition, where lower barriers allow new firms to enter and erode that profit rectangle down to zero, the core inefficiency remains. The demand curve is still downward sloping, meaning price always exceeds marginal cost. Market power breaks the mechanism that perfectly aligns a firm's private incentives with the public good. The precise shape of these curves dictates the absolute limits of a firm's power. What looks like a vast array of choices on a store shelf is often slight product differentiation, masking a market where total output is heavily controlled. Firms restrict supply because the math demands it. Maximizing profit dictates a constrained output, regardless of intent. These same curves explain real-world pricing tactics, like price discrimination, charging students less than executives, simply to extract whatever consumer surplus remains in the market. By mapping the geometry of market power, we measure its true cost. We see the exact volume of wealth captured by the firm and the deadweight loss forced onto the broader economy.